Welcome to the real estate portion of the show today. We here with the Prepare to Compete podcast, man.
hmm
We talking
hmm
all things real estate right now.
Yes,
So,
sir.
Kenneth Davis, man, how you feeling about the real estate market right now?
Man, like always, it's always a deal to be found. Just got to go ahead and navigate and search through it. But ultimately, real estate is the way to go.
Absolutely, man. Location, location, location. So now the key to real estate is that you're going to need to get a loan. Um, I don't know if y'all have hundreds of thousands of dollars laying around, but I don't. Or as Mr. Davis knows, even if you do, using other people's money can also always be a really good resource for you.
Yes, sir. Always got to make sure that, again, financing is secure. Financing is key.
So we're going to tell you today what types of different finances are options are available, and just give a little bit of information and feedback on each of those. So we're not going to delve too deep on these topics, but we just want you to kind of understand them all. Okay. So first one we're going to talk about is conventional mortgage loans. Okay. So now with a conventional loan, usually people think of that in just one way, right? When Dave Ramsey talks about get a 15-year conventional mortgage, put 20% down, or you can't get a 30-year and that sort of thing. That's usually what people think of when they think about the conventional mortgage.
hmm
However, you can put less than 20% down.
Yeah.
There's conventional mortgages for investment loans. If you're a first time home buyer, they have programs where you can put as little as 3% down. And most people, if it's not their first home purchase and they're doing a conventional loan product, it's very common to put 5% down as well as a minimum requirement for a conventional loan. To qualify for a conventional loan, you typically need a lower debt to income ratio, which we went over that in another video. We'll go ahead and put the link there for that to qualify for that one. So, conventional loans could look a lot of different ways. We have a lot of credit unions now that are offering their own versions of this product. We heard of the product with Bank of America, where you can actually, in certain markets, have a zero down program. But as our veterans may know and their families, Navy Federal has a program where you could have a conventional loan and put 0% down. They have
Yeah.
the military choice option for veterans, and they have the home buyer's choice option for anybody that has an account with them to get a conventional loan product. And guess what? They're not even charging mortgage insurance on that product.
Yeah, that's huge, man. I think that type of loan product, when a banking is offering that type of loan product, you just have to get in the door to be able to have ownership. When you talk, it's just so many different avenues of home ownership. If this is a avenue that you guys want to take, you got to make sure, one, not only to do the research, but also get partnered with the great advisors, great counsel, because those products not only are going to, one, save you money, but also save you the time and effort and stress.
Absolutely, absolutely. So, yeah, that's conventional conforming loans. The next set of loans that we'll talk about here is your government backed loans, right? So you have a FHA loan and then you have your VA loan. So they're going to work a couple different ways. With the FHA loan, you have to put down at least 3.5%, and you need a
Mhm.
certain credit score for that. It needs to be in the mid 600s to qualify for that. Obviously, the higher the credit score in any of these loan programs, the better your interest rate is going to be, right? So
Mhm.
the misnomer is that people feel like with the government loans, like, hey, you can have a very low interest rate, and you can, but sometimes depending on your credit score, your interest rate may be higher because you actually have um, a lower credit score. So credit is still important, although with these programs, there's a lot more flexibility with debt to income and that sort of thing. Now, Kenneth here as a veteran, right? Now, which program would you decide to use and why, based on the government-backed programs? Would you use your VA loan first, or would you go the FHA option?
VA. Use your VA loan. It's one of the most powerful mortgage tools on the market. I just cannot stress that your VA loan, it's going to be able to put you in the home that one that you ultimately hopefully desire, right? Depending on obviously your loan amount. But when we're talking about the details, no private mortgage insurance, zero down payment. Ultimately, we understand the VA does not really care about your credit score. That's more a bank situation. That again, you must have the bank standards or criteria for that credit score, but the VA ultimately does not care about that. All right. Again, we talk about no PMI. PMI, it could run you two, three, $400. We don't know. Private mortgage insurance. That is a huge expense to continuously pay. All right. But when we're talking about the VA home loan product, the VA home loan product ranks superior of many of the loan products out there. Some do come close and compare, but when I tell you the VA home loan benefit is something that you want to take advantage of. You want to take advantage of it every time you get a chance. Okay.
Absolutely, absolutely, and that's going to be one of the main difference with that FHA loan is that it's going to have PMI on that one. They actually call it MIP, right? They
Mhm.
actually structure it a little different to be like, oh no, we ain't got no PMI, we ain't charging no PMI on there. No, they call it MIP, and
Yeah.
what's that is a mortgage insurance premium, right? You'll pay that in two different ways. They'll actually add that as a monthly fee, which can be, $100 to $300 a month or even more. It depends on the cost of the home. And also your credit score factors in there a little bit on that because they're looking at the risk level of that particular loan on how they're charging that. And then with the FHA and the VA does this as well, they kind of charge you on the back end as well with the MIP is that what they do is they'll add a funding fee to the price of the loan, right? So if you're getting $100,000 mortgage for the VA loan, they're going to charge you 2.3%. The FHA does it a same thing, but the percentage is going to be a little different. It's I believe 1.75% for the FHA loans because the way they're looking at it is like we're charging you on the front end, and we charge you on the back end as far as having that monthly as well. So the advantage to that VA loan and compared to the FHA is that if you will have at least 10% service connection, you don't have to worry about that funding fee. So you're not paying that premium at all, which is typically 2.3% for your first time using that VA loan. And because you can use that VA loan more than once, you can use that as many times as you want to. And
Mhm.
it would be, if you weren't service connected, 3.5% for every subsequent purchase.
Yeah, most definitely. And that again, those subsequent purchases matter because when we're talking about again refinancing and trying to access other properties utilizing your VA home loan, but there's also avenues of where you're refinancing by utilizing the VA cash out method. Okay, the VA cash out method where you're still continuously able to have a reduced interest rate, okay, because it's a government backed product, and also be able to receive cash out as well. But you ultimately can go ahead and refinance out of that VA loan to be able to purchase another property of your choosing.
Absolutely. And now the government actually has a third loan product that I wasn't going to tell you guys about, but I'm going to go ahead and give you the secret sauce to some things today. Okay.
Hmm.
So,
Hmm.
you have your VA loan, that are for veterans. You have your FHA loan that veterans can still take advantage of as well if they needed to, as well as anybody can utilize that product as well. But then they have the third option is the USDA loan. Okay, so
Mm,
for the United States Department of Agriculture, fully funds this loan. It has some similarities to a VA loan, actually, for a regular consumer. But the main structure of this loan is going to be really specific to the location. And also, it has some income requirements as well. Okay, so if you're purchasing somewhere in a rural area, right? So you can't necessarily use this loan in San Diego, for example, if you're in Southern California, right? But if you're in like Temecula or, somewhere in between,
mm,
between those Indian reservations and different things like that, way out there, they may define that as a rural area and you
mm,
are able to utilize that loan. Similarly, here in Las Vegas, there's a lot of areas that are still considered rural, right? I know we watched a lot of the movies and we've seen Las Vegas grow from the movies of Casino and all these different things, right? Where it's like, getting from Tropicana to Flamingo was nothing in between, right? It was real rural, right? And you had Henderson and in different areas. There's still some parts of Las Vegas and in the Clark County where you can utilize that. It was going towards Blue Diamond, going towards that area, going towards Mesquite, right, and different things like that. There may still be some rural housing classifications there where you can look at this loan where it is fully 100% guaranteed by the government.
for sure, for sure. And those USDA loans, I don't think they get enough credit in the sense of being able to have exposure, right? Because the rural areas that you may consider not rural, they may populate on the listing of a rural area for the USDA. You'll be very surprised. We've had many veterans that want to utilize the USDA loan, and once they actually type in the zip code where they're particularly buying, they actually fall in the category. So, by being able to partner with that and also some down payment assistance programs, a lot of people are being able to get into these properties at very low cost.
Absolutely, absolutely. So that's a good one for you. And another gem here that I know, people talk about the housing crash and it's like those adjustable rate mortgages, right? Like if you're over a certain age, you hear about adjustable rate mortgage or arm loan, you like, you just cringe up. You don't even want to think about the option of utilizing that. One thing I want to say is that yes, it is a more of a riskier product. You have to be more strategic, but it can be used as a really good tool, especially in the current market here in 2023, where we are thinking that the rates may go down potentially in a year, 2, 3 years. Getting that adjustable rate mortgage that has a very reasonable interest rate on that front end can really help you with your monthly payment affordability to get into that house you want.
For sure. Yeah, yeah. Those adjustable rate mortgages. Me personally, I always try to navigate towards fixed payment mortgages. But when we're talking about strategic planning, those adjustable rate mortgages can again put your family where you want to be in regards to utilizing an adjustable rate mortgage, lower interest rates, right? Some even no down payment, right? So that at that point, if you have low interest rate and no down payment, what are you waiting on? At this point now, just reading the terms on the back end, that's the key.
Absolutely. And I mean, no lender is going to be the same with those. It's going to be a lot of different qualifications and a lot of different products. Okay. So every loan is not going to be treated the same, even in the same category, right? Because right now we're hearing like new home builders and even some of our resale lenders that work to help you get a home as well. They're using that adjustable rate mortgage very creatively to offer with 2-to-1 buy downs and different things like that. Where in your first year, you might have a interest rate of about 4%. Then the second year is 5%. Then it goes up to 6.5% that third year, all the way into that 30-year mortgage. Now, the way that they're doing it now to help people stay out of trouble, again, we understand what happened in 2008. People may have been taken advantage of with those loans, but what they're doing is that they're making sure you still qualify based on what that market interest rate on that 30-year is going to be. So,
Mhm.
how does that work? Let's say you have a 5-year ARM, right? Adjustable rate mortgage, where you get a rate of 3% for the first 5 years, but then it goes up to 7%. Well, when that lender qualifies you, they're going to be like, hey, if he does have to still have this loan in year 6, today does he make enough money to afford that 7% interest rate based on what that payment is going to be? Maybe your payment right now is going to be $1,800 with that 3% rate. Well, with that 7% rate, it may be $2,600. Does he
Mhm.
still qualify for a $2,600 payment? If that's yes, they'll approve you for that. But if you are only able to afford this home based on a 3% interest rate, and they know you won't be able to afford that 7% rate on that back end, they're not even going to put you in that product. And that's what is the primary difference. And I want people to understand that's happening now versus in 2008. 2008, there was like, your maximum payment is 1,800. That's all you could afford. We put you in this arm. We don't even care about 5 years from now that you won't be able to afford the 26. We ain't even gonna be around for that. They put people in that scenario, and that's why people had trouble. But now you're not gonna have that same trouble with that, because they're making sure you have that income up front.
Yeah, that's actually great information because though arms, can sound scary, but they are tools that can really change the trajectory of your real estate portfolio. Um, you know, I think Mr. Kayvon, Mr. Jones, you'll be able to describe a situation where best to utilize an arm, because I know you have a lot of clients and a lot of one investor clients, primary family clients. Can you provide like an example when's the best time to kind of use an arm?
Yeah, yeah. So there's going to be a couple different situations where using an arm is going to be very good strategy for you. If you essentially don't plan on being in the home for longer than that 5-year period, for example, if you're taking that 5-year arm, uh,
Hmm.
that's a good reason to do that. So, you have intentions to say, hey, I have this home now. I know my needs are going to progressively change. I'm going to sell this home within that 5-year period. Or if you're looking to house hack, right, and you're looking at an investor model, and believe that, hey, I'm going to be able to rent this house out for way more than that mortgage value. I'm
Hmm.
going to go ahead and take that on, because ultimately I'm not the person that's paying that interest rate and different things like that. You could take the arm in that situation. So there's going to be a lot of different critical ways on to evaluate. Also, if you really feel strongly that your income is going to vastly change and you'll be in a completely different financial situation in 5 years. So it's really going to
Mm.
be particular to the individual. Maybe you are a medical student, for example, and they actually have certain programs for new doctors and residents because their income has a drastic increase. So if you on your first year of residency, and then by year 5, you're going to be making a lot more money, then yeah, you can take the arm, because you know that, hey, I'm going to be making X amount, then I'm only making this now. Maybe I'm in a situation where I can technically afford it again because they qualified me based on affording it. But hey, I want to pay my student loans off, and I want to dedicate that additional monies over the next 5 years to that. Or maybe I want to save or invest over those that period, but my income supports being able to do that, you would take that adjustable rate mortgage. And lastly, if you want to gamble a little bit, right, with the market, and you think, and I don't really recommend this, if you think that the rates are going to go down, and you're like, you know what, I probably can't afford that, 7% interest rate they charge me on the back end, but I'm a gamble thinking I'm not going to actually ever have to pay that. And that's what you're
Mm,
doing. You're gambling if you're taking an arm in that scenario. So I would recommend against it in that scenario, because you want to always set yourself up for success. And the worst case scenario is that, hey, I'm going to have to pay that balloon interest rate. Can I manage my finances in my household with that? And if the answer is no, don't take the arm. If it is yes, I don't want it to be that price, but I can reasonably afford it. Go ahead and do what you have to do to secure that property, because in
mm,
most areas, you're going to have equity anyway in your home over the next 5 years.
yeah.
So, getting into the home of you that you desire, um, you know, sooner than later, in most instances, is going to help you build your portfolio and build your wealth.
Nice, nice. So basically, getting into the home is key. Um, However, Mr. Jones here will be able to help you create an exit strategy if you want to gamble. Does not recommend it at any point in time, but also it looks like as well you'll be able to create a real good strategy for them to utilize any type of one of those loan products, right?
Absolutely. Yeah. Good strategy on how to use it, because it's going to be based on the individual, your risk tolerance, and what
Mhm,
your ultimate goals are. Some people, even if it's their first home purchase, they're like, hey, I'm going to live in this house for the next 30 years. Right.
mhm,
And again, I would approach that individual planning a little differently than somebody that says, hey, this is my first home, it's a starter home, I'm going to be moving out of this in a couple years. Then that's a separate conversation. So the thing about it is that you can't just get random information on YouTube about those particular details. You need to
mhm.
make sure you sit down with a qualified professional, and we evaluate all the nuances of your particular situation.
Nice, man. Nice.
Absolutely.
Listen, I think that was, to be honest with you, I think all that information was gold, man. Dang, appreciate you educating the people and giving them some of these gems. Uh,
Absolutely, man. A lot of gems being dropped today. We appreciate you guys for watching. Any other kind of closing statements or anything that you have for the people today?
none, man. But ultimately, I would love always to wish everyone well, making sure that you're having a wonderful week. At the end of the day, please always, open up your eyes and always know it could be a little bit worse, and still remain in a space of gratitude.
Absolutely. Love to hear it, man. Love to hear it. Well, it was great speaking with you guys today. Stay tuned for the next episodes of the Prepare to Compete podcast. Stay out there, enjoy yourselves, prepare to compete. Like, subscribe, comment, do all of that. Stay on your journey towards success, man, and wealth, financial freedom, all that good stuff, man. Stay out there, prepare to compete. We out. Peace.